Buenos días. Buenos días a todos aquí de más esta edición de la conferencia anual del APLA. Quería agradecer al APLA la invitación para participar de este panel de un tema tan importante para nuestro sector, que es la transición energética. Y también quería agradecer al APLA por mantener la tradición hace muchos años de hacer la conferencia anual en la fecha de mi cumpleaños, ¿no? Es siempre una gran oportunidad de convivir con tantos amigos del sector y espero que el próximo año podamos hacerlo en vivo para no solo estar en la conferencia, como celebrar mi cumpleaños con los amigos. Bueno, el tema de este panel se llama la transición energética y productos químicos, ¿no? Cómo la transformación en la economía del hidrógeno y la conversión de petróleo y combustibles en refinerías para la petroquímica pueden afectar o contribuir para nuestra industria, ¿no? Como presentador tendremos un invitado de lujo, que es un viejo amigo de todos nosotros, Dewey Johnson, que es vicepresidente de Base Chemicals en IHS Markit. Voy a hacer una breve introducción de su perfil en inglés. Dewey is responsible for global insight and research covering the major chemical value chains, including aromatics, fibers, olefins, and derivatives, inorganics, plastics and polymers, and syngas chemicals. He's based in Houston. He has joined IHS Markit previously as CMAI in 2009. His experience in the petrochemical industry covers all aspects of the business: financial, commercial, operations, research, strategy, design, business development. And prior to IHS Markit, he was with Eastern Chemical Company, where he spent more than 25 years in strategic and commercial roles. Dewey has received BS and an MS in engineering degrees from Tennessee Technological University and Virginia Polytechnic Institute, and he has also earned an MBA in general management. He's been a frequent speaker, a guest speaker and lecturer at the MIT Sloan School of Management, at the UVA Darden School of Management, and the Albany School of Public Policy. So I'm very happy to pass the words to my good old friend, Dewey Johnson, and let's listen to his interesting insights on this very important subject of transition of energy into energy transition in chemical products. Dewey, please.
Cleantho, thank you very much for that kind introduction. And it's a real pleasure to be with you again in this very important time, and my pleasure to present. Again, looking at energy transition, what it means to petrochemicals in this space. So if we could turn to the first slide. And so the agenda, I'm going to review very quickly energy and macroeconomic outlook, just to context set, a little bit about fundamentals, and then we'll really turn to looking at what's happening in this current situation of energy transition, driven by certainly critical concerns about climate change and what that means to the downstream refining, certainly as it relates to chemicals. There's the integration issues, plastic circularity, yet another concern, and a little bit more on the energy side, but certainly impacts petrochemicals, is the hydrogen economy. So we've been doing a lot of work on that as well, and I will cover that briefly on some of the critical elements. So next slide, please. So just quickly on the economy, after a decline last year in the economy, we're seeing certainly improved outlook in 2021 as well as going forward in 2022. And all of this is driven a bit currently by the pandemic and how we're recovering from that. And we're seeing significant implications in terms of supply chains trying to recover from the shock. And we'll talk a little bit about that as well relative to fundamentals. Next slide, please. What we are seeing, of course, is what I've plotted here is some of the major energy values, all expressed in energy equivalent. So the bars represent crude oil. And again, crude oil prices rising. Here we are in late 2021. We're seeing generally the outlook, we're showing stable. We as we know, a lot of volatility on that. And then natural gas, we're certainly seeing lots of volatility in natural gas with prices that haven't been this high in many years. At the same time, while Henry Hub gases prices have risen from below their sub $3 per million BTU, nothing like the volatility we're seeing in the rest of the world on methane pricing. We do see, as you can see, really not recovering or back to some kind of steady state in the rest of the world in natural gas until mid-year next year. And so next slide. With that, that energy context, just wanted to look briefly at where we are in the industry cycle. On the left-hand side is for some of the major products, capacity utilization. This is on a nameplate basis, not on an effective basis. And as you can see for ethylene, we're still looking at an overcapacity in 2023 and then a recovery from there, as well as propylene, and then you can see paraxylene dipping a bit more precipitously, and then a long line to recovery. The one exception to that would be kind of in the middle of all of these lines is chlorine. Chlorine's very tight, as many of you will know, as well as caustic. And so on a nameplate basis, chlorine continues to come into balance. Again, this is nameplate. Effective capacity is very different for many of these products. And the resulting behavior is what you see on the right-hand side. This is earnings. And if I were showing you last year this view, we would have shown 2021 being a pretty deep decline in earnings, as well as 2022. And the same general shape of 23 being the trough, but 2021 is much higher than we previously anticipated. So if you're operating, if your asset is running, these have been very good times for producers of chemicals, driven by recovery in demand and supply chains that were maybe depleted, and then the shock in the supply chain is causing certainly in the Americas is causing a significant rise in tightness in the market and a resulting price increases. So again, this year, very good year, almost equal to the peak in 2018. And then the trough is much more shallow than previously we would have anticipated, as well as the recovery is much quicker than previously anticipated. So that's kind of where we are in the cycle. Next slide, please. And just a final item, I think, on logistics before we turn to sustainability issues. In the near term, we continue to see this disruption, in all parts of the chain. It's in the international shipping, as well as container dislocations. We know in terms of plastic, both not only pellets but finished goods, and then when it arrives locally, distribution overland and storage space at the ports. Longer term, though, this doesn't go away. Our view is that this will continue to occur at least through 2023 and maybe longer. IMO, which is regulations around International Maritime Organization, regulations on emissions are going to is causing perhaps slowdown of movement in order to meet emissions requirements. Shipping is a commodity as well. We've seen there was a lot of rationalization on ships during the depth of the pandemic. So the shipping industry is tight as well. So we will not see an easing of this situation, or certainly a relief in this situation, for a couple of years at least. Next slide, please. So after talking about the fundamentals, let's talk about what's happening in energy transition and what it means to downstream. So next slide. So one is, I'm showing on the left-hand side what's happening to refined products or fuels, primarily diesel and gasoline. And we're showing you a number of cases here, and just showing how that over time, these are our base cases. We call that inflections in our nomenclature. The base case in terms of fuels demand, we've continued to see and show a quicker plateau and a more accelerated decline in overall fuels demand from where we were in 2018 to where we are, our current case in 2021. The alternate case that we show, which is a much more aggressive case responding to climate change, we call green rules. And in that case, you see a precipitous decline between now and 2050 of fuels demand. That's in contrast to base chemicals demand. These are the major building block chemicals. You see that even despite what's happening in fuels, we see chemicals demand continuing to grow at a multiple of GDP, driven by population and increasing wealth and increasing middle class, more urbanization, and so forth. So as a result of that, as we look at major insights, what we see is upstream oil and refining companies looking for chemicals, what's an arbitrage or how to address demand risk on one side, the shifting in portfolios looking at chemicals. And so with the pressure on refining, we will see a portfolio shift in refined products, more production of chemical feedstocks on purpose instead of as a byproduct, and reconfiguration of refining. And the implications of that have to do with changing in supply of petrochemical feedstocks. And then as we see the reconfiguration and reinvestment, we will see the need to pay for that investment. And so we'll see changing in price signals on feedstocks as well. The other element is we see refining more investment into chemicals from an upstream of chemicals perspective. We're likely to see new players with new game rules, not understanding the chemical sector, and at different scale. And so expect significant disruption in that space. So the competitive landscape will remap. And there's a number of ESG initiatives, and we're going to go through these here as in the next few slides. So next slide, please. Talked about refining petchem integration, what's happening. Wanted to just show some of the linkages in addition to just the energy linkage. Certainly refining, from refining, we get naphtha, we have the aromatics box, reformate, which goes to produce aromatics. Propylene comes off the FCC units, so affecting the propylene balances, and then backflows back from olefins crackers back to the refining. So a lot of interconnectivity, and we're seeing, again, expect to see significant changes. And the other piece is we see that precipitous decline in fuels. We will see we're expecting different price setting mechanisms on chemicals. We'll talk more about that in a second. So next slide, please. Just we talk about energy transition in the oil and upstream side. I just wanted to, this is an indication of the chemicals industry is actually in a second, is the next phase behind upstream energy. So the response in the chemical side has been behind upstream, but certainly as you can see from a few snapshots of the announcements, many chemical companies responding to the situation as we move forward in terms of addressing climate change. And next slide, please. The other element around carbon, it's a critical piece. We're spending a lot of time looking at what carbon means in terms of cost structure for chemical production. And just in terms of looking at the total cost of carbon, there is explicit cost of tax structures to support how we achieve lower emissions, as well as compliance, just simply compliance with regulations that are coming, with Europe probably being the leading geography in terms of most aggressive or assertive on looking at regulatory structure. There's the implicit cost of addressing how to deal with standards and abatement funds. And then finally, how does all of that play in terms of the competitiveness of assets? And then if you'll click one more time, please. And then the other element with, as I mentioned, Europe is being more assertive than other geographies. The issue of how to create a kind of a level playing field. There's carbon border adjustment mechanisms where if you apply a different carbon tax structure in one region and you try to import into Europe, for example, there will be a tax relative to that to do the transfer, affecting trade flow of chemicals. So a critical piece going forward is previously the model for petrochemicals has been simply look at where the demand center is for growth, and you build assets where there's available low-cost feedstock. This world is changing. The new world is its competitiveness also based on carbon emissions and how that particular geography may tax carbon emissions. So it's a carbon footprint. Our clients are asking us today, what is the carbon cost that you have in your production cost by geography? So we're placing that in all of our models today, and we're monitoring policy and how that is flowing. And it varies by technology of production, by age of asset, and by geography, of course. The other element that is causing competitiveness that will change is as we look at feedstocks, there's a composition, call it mass balance, of how much feedstock is fossil-based, how much is bio-based, how much is plastics recycling, call it pyrolysis oil. That kind of composition may also be, as we look at extended producer responsibility, moving into the chemicals upstream, that may also affect cost structure, all of that affecting competitiveness of assets. So it's no more the simple, what's the market price of ethane or naphtha and what's my competitiveness, but it's what's your carbon position, what's your position on overall feedstocks, and then obviously the trade flow in terms of your customer segmentation. Next slide, please. So the disruptive realities, I think just to repeat, is pricing the dynamics of feedstocks will affect chemicals, as I've mentioned. New crude oil to chemicals, emerging technologies will need to be built. There is technical uncertainty, but we have looked at, as we look at investments on much larger scale of going, again, from crude oil to chemicals, not only what the economics of that look like and what the scale is, but what the carbon footprint is. Retrofit investments will shift refinery yields more toward chemicals, as I mentioned. If you look at that, if you look at it from a growth perspective, it becomes obvious. It's either flat to negative growth in fuels and all growth in chemicals. So if you look at where's my growth, it's a pretty quick story. There's all growth in chemicals and none in fuels. And then integration provides economic and carbon footprint advantages. Just one item, if you're running a refinery and if you look at your life cycle analysis and tons of emissions, in terms of that, if you're going to fuels, that's one carbon footprint. Chemicals can be looked at as a carbon management approach, because instead of burning of the fuel and into the environment, chemicals and plastics actually are a sequestration and storage of carbon. So it is actually a carbon management approach for refining. Next slide, please. So let me just a couple quick slides about circular plastics, and maybe the next slide. What we're seeing is populations continuing to grow, wealth overall is growing, means municipal solid waste will continue to grow. So it's not just a plastics issue, it's a municipal solid waste issue. Plastics is about 12% on average of solid waste. So the overall issue of plastics, you see plastics demand growth growing, it's really end of life. Again, plastics has grown so well over the years because it offers a wonderful value proposition. End of life is the issue. Chemicals demand is uncertain relative to recycling legislation. So again, 50% of chemicals are consumed as a plastic. So what happens to plastics and how that's regulated and how we achieve circularity dramatically affects upstream chemical production. The transition, our view is, will be policy driven, much as we'll talk about in hydrogen as well. It's about achieving scale in economics. Initially, it'll be policy driven until we reach a critical mass of scale, and then the economics come more close to linear, the linear production and the market drivers kick in as well. And I've talked about how the competitive position is affected by circularity. Next slide, please. And just a quick item on the left is, if you go around this pathway, packaging, most of the regulations are in single use, but if you look at the in-use cases, you would find that over 50% of the in-use cases for plastic are short life cycle, meaning two things. One is they have the potential for circularity. The other one is they represent the demand risk, whether you're looking at it from a glass half full or glass half empty. And polyolefins are a critical piece. So let's talk about hydrogen for a minute. I know I'm running short on time, but hydrogen is a critical item. Let's next slide, please. We hear a lot about hydrogen. It's an important area for decarbonizing in energy. The applications are in power as well as transportation, especially where electrification doesn't fit as well. So long haul, think long haul transportation of products where batteries are less applicable, and then space heating and industry uses. Hydrogen will have competition again in the short haul where batteries are more important. And then we're going to talk about the different classifications of hydrogen. So next slide, please. So this is an overview of kind of the hydrogen economy. We can go from fossil-based and steam for traditional production of hydrogen through steam methane reforming, and then applications, as I've mentioned, and then you have to get it to what are the in-use applications, long-haul trucks, and either through compressed gas and for maritime as fuels. You can see in the middle of the slide, hydrogen can be converted for use. One way is, how do you transport it? Either by liquid hydrogen or in the form of ammonia or methanol, and then ultimately for use in industry and for the different applications. And then as we talk about green hydrogen, we're going to talk about really using renewable energy, and then renewable energy into SMRs and autothermal reactors and to the in-use applications. So next slide. This is a good slide, by the way, on the previous slide on sort of the whole ecosystem. And again, kind of steam methane reformation going through. So blue hydrogen is simply SMRs with hydrogen or carbon CCS storage and capture and storage. And then green hydrogen is really about using renewable energy sources and then electrolysis to produce separate hydrogen and oxygen for a hydrogen source. So next slide. And as we talk about the economics, just it's helpful to really anchor in what $1 per kilogram of hydrogen is roughly, call it $8 per million BTU. And of course, natural gas today, call it $4 per million BTU. So that's kind of to put everything in equivalent terms. And then you can see the conversion across different items. But we're going to talk about it from an energy perspective as we go forward. So next slide. So there's a different characterization. So gray is sort of the world we're in, the conventional methane reforming without carbon capture and storage, or co-gasification without carbon capture and storage. Blue is using conventional processes today, but CCS on the backside. And then green hydrogen is, again, renewable energy, and then water electrolysis to produce hydrogen, separate hydrogen and oxygen. And then, as you can see, yellow and turquoise, but often we'll talk about blue and green hydrogen. Next slide, please. this is just looking at where demand is. So one is potential for hydrogen to displace methane. You can see the primary uses will be in industry and in transportation. And I just wanted to show, and these are our different cases. Blue inflections is our base business case, and green rules is a more aggressive move toward driven by policy and technology to a greener world. So that's our other scenario. Totally today, hydrogen represents about 2% of the energy mix. Our view is by 2050, in a base case, hydrogen will be 5% of the energy mix. And in the scenario of green rules, about 8%. Those sound like small percentages. Those are big numbers in the total energy market, of course. Next slide. And maybe just cutting to the bottom line is what's the cost look like? Again, this is expressed in cost of hydrogen, and so we see that for large SMRs, no CCS, about $2 per kg, and then as we look at electrolysis, close to $6 per kg. So let's put that in methane terms, multiply that by 8, right? So $16 per million BTU. Today, electrolysis by wind offshore, again, sort of the renewables energy, $5 to $6 per kg. So again, we're at a much higher premium than methane today. U.S. Gulf Coast doesn't look too much different than this in terms of methane reforming and electrolysis. So just a range set where we are, and we do anticipate between now and 2050, as scale grows, there's a lot of announcements and actually a number of investments occurring. We do expect to go down the cost curve, again, with improving scale and technology. So next slide. Just a final takeaway, demand growth continues. Energy transition will definitely impact chemicals, as I've mentioned, and a lot of sustainability initiatives occurring, and hopefully I've covered many of those. And Cleantho, I've not left you much time to ask questions, but let me pause there. And I don't hear you.
Thank you, Dewey. I think that was a very interesting presentation. We are a little bit running short of time, but I'll try to ask you at least one question here that we have is, I was surprised by the difference of the cost of hydrogen produced by SMR versus the green hydrogen produced with renewable energies, you know, from $2 per kilo to $6 per kilo. And we all talk a lot about green hydrogen, and that's the trend. That's cool, you know, green, etc. So what do you think will be the trend over time of this renewable green hydrogen, and how that can eventually be competitive with traditional SMR with carbon capture production of hydrogen?
Yes, it's a good question, Cleantho. And by the way, we have a full team that are spending lots of time on this. So call me the humble spokesperson for this area of work. But we're spending lots of activity here. We have a large team working on this. What we do see is blue hydrogen and green hydrogen will both work together. This is not going from gray to green. There will be both, and both are important. I would say, so today, you know, we're at, call it $16 per million BTU if you put it in methane terms or energy terms. And as you mentioned, renewable energy, you know, factor 2x over that or more. We do see that declining in half from where it is now to 2050. And it will go at different paces for different geographies. Lots of issues around capital costs, you know, all of configured in that is capital costs, cost of electricity, you know, cost of feedstock. So there's a lot of elements that are driving that cost for long-term operating and delivery of hydrogen. So I think a lot of work to be done there. Technology continues to develop, and again, I think it's just like it was and is in the plastic story. It's about continued larger scale and going down that learning curve. And we're very early in this revolution, I would say. But again, I think, and again, in our green scenario, it's really governments being mandated to address the crisis of climate change and policy driven. And it takes a while before market drivers and the economics, make sense on a level playing ground. But again, we see, somewhere it's probably around $1 per kg or $8 a million BTU before you really get economics that work on their own.
Ok, bueno, gracias. Voy a solo comentar aquí antes que terminemos, en función del horario, que pongamos nosotros a estudiar los procesos de electrólisis, porque creo que ahí está donde tenemos que tener avances tecnológicos para poder bajar ese costo de una forma significativa, ¿no? El costo de la electricidad generada por renovables ya se ve extremadamente competitivo, pero sí hay muchas cosas de hacer, ¿no? Entonces, muchas gracias a todos los asistentes. Thank you, Dewey, for your presence and presentation. Very interesting. Y esperamos verlos en las próximas sesiones de esta conferencia. Muchas gracias a todos.
Bye-bye. My pleasure.